Okay, we're going to go ahead and get started, guys. My name is Diego Mello with StratiVentures. We've been holding these sessions for about a month, and we've absolutely gotten a lot of great response to the speakers and the caliber of information that's given. And one of the main questions that we've been receiving obviously has to do with the appraisal realm. You know, obviously as real estate investors, one of the main factors of determination are values. And we have a lot of reliable realtors to work with, but we also obviously want to be able to pick the brain of our local state licensed appraisers. So we have Will Trombly from Trombly Appraisals. So we'll go ahead and so people can identify you on the screen there, wave your hand. And Will is going to be speaking to us today in regards to certain topics that are very important to us. I'm going to go ahead and I'll open the floor to him for him to go over the topics, because as usual, we keep it to a session of comments, a session of being able to ask questions, answering the registrar's questions, the people that registered, and then opening it up to a general forum there. Let's see here. Jesus de la Cruz asked, will this recording be sent afterwards? Yes. If you would like any of our recordings, please feel free to email Enid Lopez at StratiVentures. Enid, can you go ahead and put your contact information so we can get that out to everybody? Thanks for that question there. The session rules are pretty simple, guys. Let's go ahead and keep our mutes on. If you have a question when we get to that point, unmute yourself, ask your question, make comments. Please allow the speaker to answer, because obviously that's in the benefit of everybody. Respect all others' times, questions, and comments. And I know sometimes you might feel like you might have some comments to ask. Feel free to ask the speaker, you know, or to say, just ask the speaker. That's why he's here. So with that, Will, I'm going to go ahead and hand the floor over to you, sir. And let's get started with the process.
Thank you. Hey, so thank you for having me. Anthony, if you could tell me how you got that awesome background, I totally want one.
It's there's a virtual background setting that you can choose when you go to there's a little icon next to video that says choose background, and you can change it to whatever you like, really.
Okay.
Awesome. Okay. Perfect. Thanks. All right. So basically, why I'm here today is everybody wants to know what's going to happen in the market, what we're doing in the market, and how we need to protect our portfolio. And when you think about that, you need to start looking at a lot of different factors. And so I've done a little bit of legwork for you, and hopefully I can give you a pretty good idea of what your opinion will be in the next 6 months to a year to 2 years, what's going to happen in the Houston region market. I'm not talking nationwide or anything like that, just right here. This is my competency area. I want to make it very narrow focus so that way you guys understand what's going on here. Now, is everybody here from the region, right, Diego?
We actually have people from, the majority are Houston. We have some people from our San Antonio office. We have people from our Dallas office, and Laura's joining us from Mexico, and she's also with our Houston office.
Awesome. Okay. Yeah. Well, this is going to be Houston-based data driven opinions and information. So basically, everybody wants to know what's going to happen in the Houston market. We have a lot of sales in the market that have occurred throughout the last 3 to 5 years, and we have a lot of information that suggests that during events like Harvey, during events like the Great Recession, Houston really hasn't taken huge hits. We've done really well, and we've performed really well. So let's just kind of dive into it, and then we'll take some questions, and then we'll dive into it more if you want. So go ahead. Sorry, I thought you were saying something, Diego.
Keep going.
Okay. So in the short term, we may see some tougher times, some slower amount of sales for the Houston area, but we're actually have a very a stable market where we see a good amount of sales every month, 4,000 sales actually every month, almost constant throughout the last 5 years. And we don't actually go below that. We've actually keep climbing every summer to a higher average sales price. And so we keep moving forward, and there's always constant growth in the market. We actually have a $20 per day growth on average for Houston market sales. So there's different fluctuations that are going on. We've had a startup of a recessionary period before COVID-19 hit the United States. That was caused partly due to corporate tax laws that hit in 2019. We've seen a lot of inflation, a lot of growth in the stock market. I believe everybody's seen that. And that's actually been a really good driver for a lot of investors to invest in that. But at the same time, we've also seen a lot of decline, and that's partly because of COVID-19. And that's partly because of some indicators that we'll go through. So one of the biggest indicators in early 2019 was that we had a inversion of the bond markets. So the 10-year Treasury bill and the 3-month Treasury bond actually, the 10-year Treasury bill is actually usually a higher interest rate than the 3-month Treasury bill. When these two invert, when the 10-year Treasury bill actually goes below, that means that a lot of investors were driven to the 10-year Treasury bill. The 10-year Treasury bond. So that is in economics, that's actually an indicator of a recession in 1 year. That indicator actually occurred in early 2019, about February or March. Just so happens a lot of decline has happened in our current economy about a year after that. So for me, I don't believe that the market decline is solely based on COVID-19. It's actually occurring because we are in a downward trend. We had the Great Recession. We had a very slow growth period involved in that. And then we had a very slow growth. And then we had the last couple of years, a lot of growth. It's happened quite a bit, but it happened over 10 years. So this is a very long growth cycle. So we were actually looking, it's going to happen. We're going to have a downward trend. The business cycles are always up and down. So that's going to happen. So how does Houston area fare when that happens? So what I've got here, I'm trying to pull up my data here. Houston area has experienced constant growth in the median sales price of homes since 2015. We've ranged from median sales price on a monthly basis for 2015, 191,000 to about 225,000. That's 2015. In 2020, the first 3 months, the median sales price range was 235,000 to 250,000. So you're seeing quite a bit of growth overall for our market. We know that, but a lot has happened since 2015 and 2020. We had a decline in oil prices, and we had a decline due to Harvey. There was a lot of home sales, obviously, but there were a lot on the lower end. There was a lot of flooding, a lot of issues like that. 2017 was one of our biggest growths in the Houston market, even with Harvey. So back to what I was saying, why I'm telling you all this is because even though the country experiences a lot of issues in regards to the economy, in regards to regional crisis like Harvey, the tax day flood, we still experience a ton of growth. So in the next 6 to 12 months to a year and a half, you can still expect growth in the Houston market. That's what I expect. Okay. So there's some different factors in regards to the pandemic policy coming down from our state, from the Houston City Mayor. How long is our stay-at-home order going to last? I think we all expect it to last at least till the beginning of May, and maybe some opening up. But we also other countries have experienced reopening and starting the economy back up, just to have COVID-19 start flaming up again, to have more, I can't think of the word, but more people infected with the virus. And then the economy starts to shut back down again. So I think that the city of Houston and Greg Abbott expect that it could be a possibility. So they're trying to mitigate that as much as possible and do a slow startup. And these things do affect us. Right now, we've experienced a slowdown in the number of new listings in Houston, Texas market. So if we have a lack of new listings, but we already experience a shortage of inventory in Houston, we generally have about a three and a half months of inventory in the Houston, Texas market. If we start losing that inventory, new inventory coming in, we're going to see a bunch of pent-up demand. So you as investors, you're going to be able to look at this and say, okay, so if I have property now and there's pent-up demand in Houston, and we know that there's always this constant growth in Houston, then my properties are going to be actually worth more later on, not less, if we get out of this stay-at-home orders. All right. Now, if this goes on for a long period of time, if we're staying at home till November, maybe we'll have another meeting. But I'm hoping that does not happen. Any questions so far, Diego?
Yeah, well,
I've spit out a lot of info.
Yes, and I mean, I guess just to set the platform there about what you do and at the level of what you do, I know one thing from you, Will, is that you have a very analytical background, and most of all, the appraisals that you do appraisals for a lot of large organizations. Can you give us a little bit of what the ones you do?
Sure. Yeah. So I work for J.P. Morgan Chase, Wells Fargo, Movement Mortgage. There's probably about 40 different lenders, but those are some of the bigger ones. Let's see, Quicken Loans. That's probably one of my biggest clients. I'm working on the purchases and refinances, cash outs, and we probably do anywhere from 1,000 to 1,500 orders a year. So it's a lot of work. Yeah, absolutely.
That's great. And then for those we do have new, seasoned, and also people that are not within the real estate environment. If you were to give us the 1, 2, 3s of what an appraisal report would encompass for knowledge base, then we can lead to questions.
Sure. So all appraisals are subject to your intended use, what you're going to use that appraisal for. If you're going and you're purchasing a home and you need to get a loan, you're going to get a 1004 URAR form. And what the appraiser is going to do, what I'm going to do is I'm going to come out to the property and I'm going to do what's called an improvement analysis. An improvement analysis means I go out and I sketch the property, I look at the condition of the property, I look at the quality of the finishes of the property, and then I put that in my report. Then you're going to go ahead and you're going to do I'm going to do a sales comparables analysis. And a lot of you are very familiar with that. You go out and you look for comps. You look at comps and try to find the best comparable sales that identify what that property looks like. Excuse me, what that property is worth. So if you can find the best sales available and you can develop a well-developed opinion of value, you can use that approach to write your report. There's two other approaches that are involved in appraisals. They are the cost approach, and then there's the income approach. Income approach basically means if you were to rent the property, how much would the property be worth based on like a cap rate? Similar to that, it's a gross rent multiplier. And then you go ahead and you can do the cost approach. Basically, what would the cost of the home be to build new minus depreciation because of the age of the property if it's not a brand new property, and then add the land value on top of that. Those other second two approaches, besides the comparable sales approach, are not widely used. They're generally used only if the property is a rental property, in case of the income approach, or if the property does not have a lot of comparable sales, you would use the cost approach. And then you write your report, send it in, rock and roll. Everybody's happy, right?
Absolutely. Now, one of the understanding there is that appraisers now there is a third party review that's submitted to, correct? Is that to keep the legitimacy of the appraisals, and that's been going on for a while? Can you explain a little bit about that?
Yeah, so there's different aspects of that. Appraisal management companies, AMCs, which I get a lot of work from, a lot of appraisers do get a lot of work from, is basically it's an intermediary between the banks, the mortgage companies, and the appraiser. And the banks hire that appraisal management company to go ahead and issue the order down to the appraiser. So this appraisal management company on a yearly basis actually has to get reviews on all their appraisals. They have a review process when I submit my appraisal, and they go ahead and review the appraisal. They kick it back if they have any questions or there's something I need to explain. Or and they also on an annual basis have to get, I believe, somewhere around 30% of their appraisals reviewed by another appraiser, not by them. So that's an interesting aspect, that 30% of the lending work that occurs in the nation actually gets reviewed by another appraiser. So even if your realtor looks at it, you can understand there's already being reviewed work done on these appraisals.
Okay. Thank you for that there. We're going to go ahead, guys, and start. The people who registered and had a question, we're going to read off some of those questions. If Will has gone ahead and answered that, then we'll go ahead and just bypass that question. We have Will Borrell, obviously, he was one of our speakers from the Loken Group, sent in this question. It says, we have started to notice more appraisal shortages for contracts in the last 6 months or so. They're curious to hear what your thoughts are on that, and if you've noticed the same trend. I'm assuming he's meaning that based off of what lenders are thinking.
Yeah. Is Will Burrell talking about the local region or
Yes,
nationwide?
yes, locally.
Locally?
Yes.
So locally, there's, in the last 6 months, I'm unsure why there's a lack of appraisers available. I couldn't tell you that there is high demand for appraisers right now. We're doing a ton of refinance work. I see 40 or 50 come across my desk every week, and I can't get to them all. So maybe there's just a lack of availability because we're swamped. There's just a ton of work to be done.
Okay, good. This question here, one of our attendees asked, are there any quick and inexpensive methods of verifying property values online? And in your mind, which would be the most accurate? Obviously saying always use an appraiser, but you know, investor mindset.
Okay, so there is a lot of AVMs, automated valuation models out there, like Zillow. If any of you have experienced the disparity between an appraisal and the Zillow estimate of value, you'll know that Zillow is actually not a great indicator of value. There's other AVMs out there, and I haven't seen anything that's really accurate in regards to Houston real estate. But I would go ahead and consider the tax card value, and then generally, not always, add 10 to 20% to it in the Houston, Harris County only for here. That is a quick and inexpensive way to do it. It's not accurate, and you could definitely be leaving money on the table if you do that. Especially if the property is not updated on the tax card, hcad.org. If the condition or the bedroom or bathroom counts are not updated, it could be absolutely wrong. So make sure that you're reading that correctly when you're considering that valuation approach.
Okay, thank you for that. This is a question from Tom Parks. I know he's on right now. And Tom, let me make sure I get this correctly here. You wrote there changing valuations. And my understanding and what I'm reading here is, are you foreseeing anything new coming towards the scope of the way you guys look at evaluations from now on? Or is that something that's still considered a third party?
No. So there's multiple ways to value a property. We can use the 1004 form. You can do a desktop appraisal. you do a drive-by appraisal. Is that what Tom means by changing valuations, or is he looking at changing the scope of work?
Well, let's take a look there, because that would encompass then a question by Myra is, can you change the evaluation or re-look at an appraisal? So Tom, if you can, go ahead and unmute yourself and ask that question for clarity. Let's see here if Tom can unmute. There you go. Tom, I've unmuted you, sir. Oh, okay. Let's go ahead and move on.
Okay.
And the next question here is from Myra. She wrote, are you able to challenge any appraisal value? And if so, what is the process?
Okay, so what you're going to do is you're going to get with your lender that ordered the appraisal, and you're going to go ahead and ask them that you want to, basically what you said, challenge the appraisal. What you need to do is, a lot of different lenders have policies in regards to that, and they may give you a form, which is great. Fill out the form, adhere to the rules that they're asking for. If you don't adhere to those rules, I might not have received that form. So if a lot of the rules encompass making sure that the comparable sales that you're suggesting, and make sure you have comparable sales that you want to submit to the appraiser, but make sure that they are within 6 months or more recent, depending on the lender. That's a big one. But make sure that when you want to challenge the opinion of value, that you're trying your best to use comparable sales. One of the things that I see a lot when I get a challenge to an appraisal, which doesn't happen too often, but when I do get that, a lot of the times I see comparable sales that have been chosen to support the contract price or to support what someone thinks that the value opinion is, not necessarily what is the most comparable sale, what is the most similar to the property. So if I make an appraisal, if I write a report and I've obviously made a mistake and someone catches it, and a realtor, an investor, and a homeowner say, oh no, you need to look at this property right here, and that's actually a more comparable sale, I will absolutely put that in my appraisal. And if it changes the developed opinion of value, I'll absolutely revise it. It's happened.
Excellent. Thank you so much for that there. And Myra, great question. Raquel Molina asked, are foreclosures considered when appraising a property, and what factor do they take?
Okay, so foreclosures are generally only used if the home that you are appraising is in fact a foreclosure, and you're going to sell it. Generally, this is why you would do a foreclosure appraisal, is if you were going to sell it as an REO property, a foreclosure. Now, there are other reasons to use a foreclosure property in appraisals. One of them is to bracket condition of the subject property on the lower end. If you have functional issues in the home, like there's a hole in the roof or it was on fire 3 days ago, you may need to have an REO property used, because REOs generally are in poorer condition and they may actually bracket that condition on the lower end. Other reasons to use it, very, very few. If you do use it, an appraiser should be talking about why they did use it in the appraisal. You should look for that if you do see it.
Okay, thank you for that. We have a question here from Vanessa Duhan. Asked, is there a different cost for the 3 different appraisals you mentioned? How long does it take to get the appraiser for the property, and how long will it take to receive the appraisals?
Okay, so a desktop appraisal is the cheapest and the fastest one. At the same time, it's not the most accurate. Accurate in regards to what I do is it's very accurate, but in regards to your intended use, it may not. I tailor my appraisals to you, what you're going to use that appraisal for. So a desktop appraisal, I'm not going to use that if you're going to purchase a property. If you're going to do a preliminary analysis on a property and you just kind of want to have a ballpark of what the market's doing, what the inventory looks like in that market, and how the property performs, then a desktop appraisal will work. If you give me a large amount of volume for desktop appraisals, say 20 or 30 a week, obviously I'm going to come down cheaper. But right now, my standard fee for a desktop appraisal is $125. Now, a regular appraisal 1004 for the purchase of a property. We're going to do this for a hard money lender, somebody that's already approved me to have me on their panel. The appraisal for a as-is appraisal is $400 right now. These fluctuate. When I get slower, they come down to $350. When it gets really busy in the summer months, I go up $500, even more. Now, for the drive-by exteriors, a lot of you guys are probably not going to use that as much. But if you need a valuation and you need to see what the exterior of the property looks like, and you just want somebody to go check on it, you can wrap that all in one in an exterior appraisal. So it's a lot like a desktop. And you would use that for a preliminary analysis as well. That fee is $250.
Okay. And here's a question that was sent in. If we don't have comps available in an area, what type of weight will the appraisal hold to a lender? Should we always be getting an appraisal?
Could you say that again? I'm sorry.
Okay. If we don't have comps for an area, obviously I'm assuming they're looking for validation comparable or after repaired values, but there's no data. Okay. Should they be obtaining an appraisal? And if they do, what type of weight will that appraisal have towards the lender?
Okay. So that actually is going to amount to what the lender's policies are. If they're sending their loans and they're selling them out on the secondary mortgage market, they don't, they got to free up capital. Then, and most do. Then the weight of the appraisal is going to be very significant. So if in the event that you do not have comparable sales, then you should definitely get an appraisal. We can do things that a lot of people are not knowledgeable about, like the cost approach, that can help develop a well-developed opinion of value and not shooting from the hip. And that's important, especially when you're lending out $100,000, $200,000 on a home.
Excellent. Thank you so much, Will, for that. We're at our midpoint of our session, guys. We're going to open this up now to our Q&A session. Will, if you want to go ahead and answer these questions, people now, sure. You guys can either via chat send me the question to say it, or feel free to raise your hand physically so I can see it, or go ahead and raise your hand via Zoom, and I'll be happy to identify you. Lynn Deffenbaum, you raised your hand. Feel free to go ahead and ask Will your question.
Yes, well, something I've always wondered about is how does an appraisal evaluate the interior of a house? Our business is renovating the inside as well as the outside. And it's a big difference between one rehabber and the next. If you go full boat or only halfway.
Okay. Yeah, and that's a extremely significant factor of value in the Houston, Texas market. We have a lot of homes that are similar in age, and we have huge subdivisions, but the biggest difference is how people finish those homes, especially with investors. So I most particularly weight that very much in my analysis. Try to give you an example. Obviously, hardwood floors and vinyl plank floors aren't going to be happening in the same rental community. So I'm not going to be weighting these two homes similarly to a subject property. And those are significant factors for sure. I can't give you a number in regards to how I weight that, because it changes based on the market and the data that I have. I hope I answered your question, Lynn.
Do you go inside the homes to see?
Absolutely. Almost every time. If I have the ability to go inside the home, I definitely do.
Yep. And Lynn, one of the main factors there is, like you guys have heard me say in class, is you don't want to build a Mercedes with Hyundai parts, right? So we want to go ahead and make sure that the appraisers give us that type of assessment, especially if the lender is going to be generating loans towards repairs. Fabian, yeah, you have a question, buddy? Go ahead and unmute yourself and ask.
Yes, two questions. The first one is, when you put like a water filtration system for the whole house that in most cases costs like $5,000 for the house, or the solar panels, like typically it's like $20,000 to put in a house. do I get that money back when I sell the house? Is that a good investment or not?
So it's going to depend on your market most often, but generally, no, you're not going to get your money back. If you're receiving income and you're getting your utility bill cheaper on your solar power, great. But at the same time, you may have signed a lease to pay off that solar panels as well. So not necessarily. When you refinance your home and you get a refinance that's significantly cheaper on your interest rate and your value went up because of that for your solar panels, then yes, that's great. I most recent solar panel appraisal home I had a couple of months ago, and I think it raised the home value up about 16 grand. I didn't have a comparable sale that had similar solar panels, but I did put that home on the higher end of my adjusted values for comparable sales. So it did help, but are you getting all your money that you're putting into it?
Probably not.
That's a finance question you got to ask yourself. You got to look at the numbers.
Yeah, you got to look at the cost to investment there, and certain areas are different. You know, the Austin market, absolutely. You know, people in those vicinities have that. It's a great question there, Fabian. Jolanda, oh, go ahead. Second question, go ahead.
Yeah, I own a house inside of a townhome community. We don't belong to the townhome community. I guess they built the townhomes after the houses were built. So it's like only 10 houses inside the community. And they cut the grass, they have security, and the pool service, whatever. And we don't have to pay anything like HOA, or we don't belong to them. Is this a good value for the house, or the other way around? Since
Absolutely. You have community services and you guys don't even have to pay for it. I'm surprised you don't have to pay for it. That's fantastic.
Restrictions.
Yeah, no, that's great. I wonder that if, well, that's a complicated statement. I'm not even going to say it, but that's an excellent marketable factor. Not necessarily one of value. You could be competing better against homes that are in townhomes that are nearby because of that, but it's not very well known, and if it's not well known among the markets, then it doesn't play a huge part in the factor of value. Okay.
And Fabian, one quick question here: is your community, are they single metered or master metered? How are the utilities? I'm sorry?
Went away. Can you repeat the question?
In your townhome community, are they single metered or independently metered, or is there a master? And the reason being is that when you do have a master, you would obviously have to designate somebody for your common area
Single
maintenance.
meter is independent.
Exactly. Yeah. So that's a benefit there for a single meter independent. So good job there. Jolanda, go ahead, and then Bliss, you'll be next.
Okay, my question is, are realtors and or investors advised to be at the appraisal if they know the date and time of the appraisal, or rather, is it okay?
Okay, it is absolutely okay. It is generally a preference to the appraiser. You don't want to impede the speed at the appraiser that they're working. You want to get it done as fast as possible, right? But at the same time, you want to give them as much information as you can. If you feel comfortable, you can email that information, talk, text, call, and I will be happy to take it. I take comps, I take the improvements that have occurred in the last 15 years. All that information can be sent over email. I get people sending me packets. That's totally fine. Just put it on the kitchen counter. You don't need to meet me. If you want to, you're more than welcome to. I encourage it for a lot of people that don't know me and want to create that relationship and just kind of build some trust. You're more than welcome to.
And Jolanda, I can vouch for that. In the past, when Will was first getting started, he actually spoke at some of our member meetings, and has still to this day been open to the factor of additional supporting data. Yep. Bliss, go ahead, sir. Okay. I'm sorry, Bliss. Bliss, go ahead.
Okay. My question is about going into a neighborhood that was, say, built in the 50s or 60s. You buy a house which turns into being a tear down. So you're going to have to basically rebuild a new house. But comparing the idea of valuing essentially new construction in the neighborhood versus having an overvalued property, an overimproved property in the neighborhood, how do we look at our value there?
Sure. So there's different ways of doing that. One of the best ways is to, I'm assuming that you're talking about rebuilding the property as it used to look, or just putting a new piece of property, new style, new quality. Which option?
Similar style,
Okay.
but I would build to the equivalent of the largest house in the neighborhood.
Okay. So what you're going to do is you're going to be building a brand new piece of property. So a new construction sales in the area are going to be your best comparable sales. It's going to be a brand new foundation, brand new studs, everything. You're going to use new construction. Now, if you're not going to be doing a new construction and you're going to be remodeling the home to the nines, you're going to go through to the studs, you're going to do everything. That means the property is going to be like new. So if the property is like new, yet it was still built in, say, 1965, like my home, then what you're going to be doing is you're going to be having a property that's like new, and the style and design is not like a new property. So you need to adjust for having the differences between a new construction home and new styles and design that are very marketable versus homes that are older. So that's really important to take into effect. Oftentimes, go ahead.
One of the circumstances I saw was a house that was bought, and because of extensive damage had to be taken down to the foundation and rebuilt. So it's like new construction except for the foundation. Where would you go to get your comparables? Because not every house in the neighborhood has had that done to it.
Not every house has had that happen. So what's going to happen is you're going to look at sales in that market that are very similar to your subject property, that are like new. They're just, everything's been done. Electrical, plumbing, roof, exterior, cement board or hardy board. You're going to be looking at the kitchen. Everything needs to be redone, right? When you do that, that property is still inferior to the property you are remodeling because you only have a foundation. You redid everything. So it's almost like new. So then you're going to go and look at a neighborhood sale outside of your neighborhood if you have to, a new construction home. And you're going to weight that new construction home much less than your comparable sales that are like new, but you're going to put it in your analysis. Does that make sense?
It does. How far above the neighborhood market value can you go before you consider yourself having an over improvement?
Well, that's an interesting question. So what you're going to be doing is you're going to be looking at active listings in your area, and you're going to be looking at what the market is asking for and what they're selling. So you don't want to be going and looking and saying, all right, this is where we are, and I am 20% over these active listings. And then you look and you expand out from your neighborhood and you look at other active listings that maybe are like your property, that are brand new construction. Your new construction active listings are superior to your property that has the old foundation and the old site improvements and the plumbing and the drains. Okay. So you're not going to go above those new construction listings. Does that make sense?
Yes.
Okay. And Bliss, one consideration that you also want to take is the area in which you're in. Bliss actually is in San Antonio, and San Antonio having a large amount of historical. We've entertained exactly what you're doing or what you're planning on doing for some of those transitional areas. And, you know, Alamo Heights and all those areas, a lot of that's happening. So you want to also take the consideration of the lender. You know, what is the lender considering to what they're going to lend against, what type of asset, what the final asset is going to be. So Jenny, go ahead and ask your question, Ms. Hammond.
Okay. My personal residence, I have about 60 to 70% equity, depending on how it would be valued. But I have been thinking about refinancing it in order to get some equity out to invest in passive income property. Right now, though, my current mortgage company says they're not doing any appraisals in occupied properties because they don't want to risk infection or spreading infection or whatever. So they said I cannot do a refi through my lender.
Mm-hmm. Yes. Go ahead. I apologize.
I'm just wondering, you know, are you doing appraisals? The only obstacle they said to doing a refi with a cash out on my equity is the appraisal.
Mm-hmm. Yeah. So Fannie Mae's came out with some new guidelines in regards to what we can and can't do, what we can do in regards to flexibility of appraisals. And cash out refinances are the one exception to that flexibility. You still need a traditional interior home inspection and appraisal. Currently myself, I'm not going inside homes to do appraisals on occupied properties because I don't want to spread infection. Say I got infected by someone and I'm tracking it through your home, Jenny, if I were to come for your cash out refinance. So I couldn't do that to myself. I could, if I had, well, let's not dive into that, but what's going on is, like with Wells Fargo, they're not allowing any appraisers into properties. They don't want anybody to do it. So what you have to do is go through a different lender. You can't use that lender, basically. Cash out refinances don't have the flexibility of the appraisal, and you'll need to go ahead and find a different lender that will.
Okay. All right. Thank you.
Thanks for that question there, Jenny. Right now, does anybody have an, okay, there you go. Lynn Michael Pettis, if you don't mind unmuting yourself. You've always got good questions.
No. So my question has to do with, I asked, have you appraised a residential assisted living facility? And if so, how is this done? Because how would you have comps that take into account sprinkler and security systems, ADA compliant construction, etc.? And then, go ahead.
That's a good question. I'm not a commercial property appraiser. I only do residential homes.
Well, interestingly enough, they're not considered commercial. They don't move over into a, they're a resident. You're looking for, if you're gonna, for instance, to convert a home, you're largely gonna look for something that's like 5 bedrooms, 4 bathrooms. In the state of Texas, you can have up to 16 residents in a particular licensing category. And be a residential assisted living. I'm looking to do this, and I mean, how would you get it appraised? Or, and similarly to that, well, along with that, how if you're planning on converting residents to an RAL facility, how would you go about getting that appraised? Or would you just basically buy the property as is?
One characteristic, if you find yourself working with me, is that I will not answer questions that I am not competent in answering, and I don't know. I actually don't know. You would have to ask a certified general appraiser. It sounds like that's a income producing property, or it goes to the state, however that works. But I'm not competent to answer that question.
Okay, thanks.
Mm-hmm.
Okay, thanks, Lynn, for that. Fabian, you have a question? Go ahead.
Yes. What do you think about new construction? Starting new construction right now, and the sales price will be about $260 near downtown.
Near downtown, it depends on the quality, and it's also going to depend on what's already on the market. So to develop your own opinion, because I can't say, all right, $260,000 near downtown. I got to know what the property looks like. That's a really big factor. But what you can do is you can look at active listings in that area, in your immediate area that you're going to build, and you can say, all right, this is what properties are listed for, and this is how many cumulative days are on market. So if you got properties that are new construction similar to yours and they've been on the market for a year, I think you can create an opinion, right?
I mean, today looks good. It's just in 6 months when it's finished, I don't know how's the market going to be.
Yeah, that's very true. Diego?
Yeah, I can tell you that because right now we're in the process of, we purchased some tracts of land that we're going to be building on. And one of I guess the main question wasn't a value, because it's all forecasted value depending on what the after constructed value of the property plus what you're putting into it is your lender's gonna, the main question the lender was asking us was how fast are you gonna finish this? There's so many uncertainties right now on labor, cost of material. You know, there's so many factors that can hinder the scheduling of obviously 11 to 16 draws in your standard build, that, you know, your lender doesn't want this 6-month projection to become 12 months. Do you see what I mean? Because within those 12 months, you would have gone into 2 cycles of whether it's in the summertime or whether it's in the winter time. And that plays huge factors. Another thing I can tell you, Fabian, that you need to consider is, you said somewhere near downtown is, are you doing this independently, or are you going to be competing, or what's your competition? You know, there's obviously larger competitors out there that can have 30 units on the market and take a hit on 15 of them and still be profitable. If you're looking to build 1 or 5 units and subdivide, you got to be very careful, because they can take more punches than you can, especially when it comes to time. So I would have to say, look at your how are you going to get this done is your primary thing. That's what we've been hearing. Laura, go ahead and ask your question.
Hi, everyone. I hope you're all well. My question is, regarding what Tom was saying about the early recession in 2019, and now with this hit with COVID, obviously we're going to see adjustments in the ARVs, right? Although Houston is going to continue to grow. So my question is, but how should we adjust the ARVs? Like when Harvey was, no one knew, right? So they started doing 15% less, 20% less. So what would your suggestion be as how we can be conservative on the numbers and new ARVs to work?
I think, sure. I think that if you had policies that you created during Harvey, to go ahead and maybe reenact those, not right now, because there's a lack of inventory growing and there's going to be pent up demand. But if we are in stay-at-home orders for another 3 months, go ahead and put those Harvey policies in. Go ahead and start having them come in now. I'm not going to tell you 10 or 15% because I don't know what market area you're in, but go ahead and start looking at those policies, especially if you're still doing the same type of investment properties that you were during Harvey. Make sense?
Okay. Thank you.
Yep. And Laura, also consider the market drivers for that area. Obviously, you know, South Houston, you have shipping, you have trucking, you have, air and space, you know, refineries. You got to look at all of that. You know, those are key indicators there too. So guys, we're going into the last 8 minutes here. So Will, if you want to go ahead and give us some closing statement and just a little bit more about yourself,
sure.
Then we can go ahead and finalize.
Sure. Okay. So to recap, there's been growth in Houston, regardless of what has occurred in our economy and regional crisis. So I expect continued growth and a stable market. There could be in the short term some lack of inventory, some issues, some lack of sales, just because of the stay-at-home order. But in the long term, 6 months to a year, we'll be back and demand will be rocking and rolling. I work with investors and I'm happy to work with you guys. Just give me a call, email, whatever you like. Let's get to work.
Excellent. And guys, if you do want a copy of this recording or of this session here, please go ahead, Enid, and put out the contact information for everybody to reach out to you. And as normal, we really appreciate you guys joining. I think we had a 3 or 4 pager here on this session. So Will, appraisals definitely hit the market there. Another thing I want to let you know that next week we are shooting to have a all-state insurance broker who's going to be answering questions in regards to insurance. Obviously, that's a big one too. So we're going to have those web forms going out. And I do want to state this. I apologize if you're having to redo the web forms over and over again. We do have your information, but it obviously allows people to ask questions. But most of all, I hope we have been bringing value. And please follow us if you guys can on all our social media. We'd love to get feedback from you on how we're doing, and most of all, how we can bring more value to everybody in the community. So I would love, thank everybody for joining us, and have yourself a successful week. And we hope to see you next time. Thank you, Will, for your time.
Thank you. All right.
Thank you.
Thanks
Bye.
for having me. Bye.
Gracias, Diego.
Ciao, Larita.
Saluditos.
Gracias, Diego. See you then.
Everybody have
Bye,
a great-
guys. Thank you.
Thank you.
Thanks, Diego.
You're very welcome.
Nos vemos pronto por Houston, algún día espero.
Ahí vamos, señorita. Nos vemos pronto y cuídate mucho, por favor.
Sí, igualmente. Bye.
Chao.